Hey guys, it's Eric Heckman, and just wanted to welcome you guys here. And let's see, we're going to put out a poll here. So let me see. Hopefully that poll is already there. Waiting for everybody to sign on and just kind of log on. It always takes people a tiny bit there, but so yeah, let me tell me when you think you're going to be planning to turn on that Social Security. Is it early? Is it 65? Full retirement? 70? It'd be just good for me just to find out. It's a little tough on webinars to have people raise their hand, right? Woohoo! A way to go for that. So yeah, let's see here. Wow, it's kind of all over the place there a little bit. So we'll give it a little bit more time on that. But again, my name is Eric Heckman with Heckman Financial. And really, the reason why I'm here is there's a lot of confusion about Social Security. It seems easy, it seems kind of cut dried, but it's not quite as simple as it seems. And there's also a ton of misinformation out there. Not that it's intentionally wrong, it's just not thought of in the right direction, and there's little nuances that are left off of the discussion. And so, that's really the goal tonight, is to find out, okay, for me in my situation, when should I do Social Security? Because if you ask somebody, they're going to give you some generalities, and often those could be the really wrong times. Especially if you're married. If you're married and you're close in age, there's a lot of reasons why you might even want to start sooner. So right now, let's see on the poll wise. Let's see, yeah. So we got almost 44% are full retirement age. So we'll go over that jargon or lingo or whatever you want to call it. But yeah, so you guys can keep kind of doing that, and I will get into it here. So this is America, so we got to have a disclaimer. I don't work for Social Security. I don't have anything to do with them. Obviously, Social Security is a part of everybody's retirement plan, and you got to know how to do it, when to do it, and what's the best way to utilize it. So, that's our disclaimer. I'm a registered investment advisor. I have a fiduciary duty to do what's in your best interest and to help you out. And that's what we're here for tonight. So we're not going to, what are we going to go over tonight? We're not talking products. We're not talking sales, pressure, any of that stuff. Really, we're just kind of trying to get you that education on Social Security, how to optimize it, and then also how to think about it in terms of your overall investment and income picture. So when you're talking about having an income plan, obviously Social Security, I hope, is only a part of your retirement plan. It should be in addition to all your other assets. So that's the key thing, is making sure that you're not just only thinking Social Security and that's it. So this is, how does it fit into everything else that you're doing? So yeah, let's see. Well, the poll there, let's see, we had 50% at full retirement, 14 at 70, but 28% at 62. So that's kind of interesting. So we'll go over that and the pros and cons about doing that. And as I say that, a whole bunch more people respond to the poll. So so one of the things that's got to be out there, right, is I don't know if you guys saw this. This was 2 weeks ago or so. They have to do this updated report every year, Social Security, and basically what they said is that 2034, they'll only be able to pay 78% of their benefits. So that's kind of like me and you going up to our mortgage company and saying, hey, is it okay if I only pay 78% of my mortgage? They're going to say, no, it's not okay. We've known about this for a long time. This report actually has been going on forever, and it's always been between anywhere from 2034 to 2037. It's bouncing around those years. There's nothing new about this issue. It's one we've known about for a long time, because as how many people are retiring, especially the baby boom generation, we need to make sure there's enough workers to replace those earnings and pay into the system. And so that's one of the things that's going to be changing. So what can they do? What should they do? They've already done some stuff, obviously, and we'll go over some of those changes. So what are things that could change? Well, one, of course, is the retirement age, and we'll go over that a little bit more. In that retirement age has already been moved, but they can move, especially, I think, the lower one. They didn't lower the age 62. They did not move. They only moved from 65 going up to 67. So why didn't they move the lower one farther up? That could be an easy one for them to fix. Obviously, inflation adjustments, they've actually already done that with the Trump tax laws. They actually changed what CPI they're using. They're using this one called a chained CPI, which tends to go a little bit lower and slower on those cost of living adjustments. And then earnings restrictions and obviously taxes, right? So those are some of the changes that they might do, but really, I think for anybody in the next 10 years who's turning on Social Security, it's going to have a zero effect. Just because historically, they've never done anything to somebody who's about to get a benefit. It's always people behind it. So those are the people that have to really start saving even more. So how do they figure this out? I mean, what is the whole crazy formula that people have? You used to get these nice statements. If you get one now, it's sometimes amazing, but if you're over 61, you're supposed to get it in paper. If you're not getting it or you haven't gotten one, you can go to SSA, so Social Security Administration.gov. Actually, it's in the bottom corner there is the slide. And you can create your own account. And I would really encourage you to do that. They do all those goofy security questions from one of the credit bureaus and such. So assuming you can answer all those, you get in there. Then you can look at your statement and see what's going on. Obviously, every year, every time you file your taxes, well, actually it comes off usually mostly off your W-2s, but also if you're self-employed or a business owner, you come off your tax return. So, you do want to see like, did 2020 update and what's the numbers now? Why is that important? Well, Social Security only figures out one number. There's only actually one calculation they do. That is your full retirement age. They don't calculate anything else but that one number. And that number drives all the other numbers. So that number is very important to know. How do they do it? It's your highest 35 years of earnings. So maybe you were a stay-at-home parent for a while. Maybe you weren't doing stuff for some time. So, if you were doing that, then, you may have had some zeros for quite some time. So maybe you've got 10 years of zeros and 25 years of earnings. Well, if you earn more money for one more year, that year is going to replace that zero. I have a lot of clients also that weren't in the country the whole time. They've maybe been here for 20 or 30 years, but they don't have all 35 years of earnings. So every year you work, it will go up because of that. If you've already had 35 years of earnings, then if you earn more, it's going to replace one of those lower years. Maybe you had a paperboy route, or maybe you're working McDonald's in college or something like that, right? So maybe some of those lower earning years are going to get replaced. And so that's one of the things you want to look at. And so what they do is they figure out your full retirement age, and then they penalize you down to 62, and they reward you up to 70. And so that's the main thing to be thinking of. Now, the biggest problem I have with these statements is the very second line, or the second part of that line, and it's always cut off and goes to the next section, is if you continue working until. So say you weren't making that much money for 10, 15, 20 years, and then you've been doing really good for like the last 10 years. And so you're at your 35 years of earnings, but you're going to be maxing out Social Security for the next several years. And so you're going to be having that money, if once you get that, 157, you're max out Social Security. So, you're going to be keep hitting that limit. Well, if you get a projection of what age 70 will be, it's going to be replacing those bad years from way back when. And so that's age 70 won't be quite accurate because it's going to be a little overstated on those extra years if you had a big curve of income. Now, if your income was pretty much, the same as it was before, it's going to be not a big issue. So if you stop working at 65, the full retirement age number will be a little bit overstated, but 70 will be a lot more overstated because you may not have those earnings, or they may not be that big deal, depending, of course, what are your earnings today and where you're at. So again, this is why it's really tough to, do this as a general thing. That's where, if you want to set up a time to set a phone call or a Zoom call, we could do that and we can kind of go over that. But that's the first part you need to be knowing about. So what's the second part? And this slide's really tough to read, and hopefully you're not on your phone because it'd be really, really tiny. But I like to use this next one here. So we'll skip to this one. This is a really great slide. It's super easy visual of what happens. So say your full retirement age is 66. Well, if that's the case, that was last year. So what happens is, they did have this phase in. Actually, hold on, maybe I should go back to that. So they have this goofy phase in. So if you're born 55, your full retirement age is maybe this year. It's your 66 and 2 month birthday. Try to find a Hallmark card for 66 and 2 months, right? But so if you can find that card, or so they at least figure out that date, that's your full retirement age. So every year from 55 to 59, it goes up by 2 more months. So 66 and 4, 66 and 6. Once it's 1960, if you're born 1960 and after, everybody is 67. So we're right now in the right dead center of that phase in where we're just starting those goofy years and that. So that's why I can't say your birthday anymore. It used to be your 65th birthday way back when. No, we can't use birthday. We have to use the full retirement age, or FRA thing, because like I said, if you're born in 1955, it's 66 and 2 months, not 66. So what they do is they figure out that full retirement age. And if you want to start early, they penalize you down. Now, this slide is talking about somebody who is doing, who's already, now is 67. They actually only had a 25% penalty for starting at age 62. Now that penalty is actually 30%. So it's gone up. Well, it kind of phases in also along with those phases, but by the time somebody is age 62, you can see down here it's 30%. So it's like this year for 1955 people, it's 25.83, kind of goofy numbers. But again, it's about a 30% penalty if you start at 62, and then they add up to 32% if you're going all the way to 70. Well, they add 8% a year. It's not compound interest, it's just simple interest. But again, if it's 66 in 2 months, it's not full 32 anymore, because you're not getting those other 2 months. And then each year it's going to get a little bit less benefit waiting to 70. So that is just for your starting point, right? If you're married, it's not talking about your spouse. So, and then another jargon thing, or phrase, early versus late. So full retirement age is normal retirement. Early is anything before your full retirement age, 62 and up. And then if you go past 60, your full retirement age, all the way to 70, that's late. There's no reason to not turn it on at 70. Please turn it on at 70. Don't be crazy. You're just donating money to the government. Get the money and donate it to a charity you like, not the government. So definitely turn it on then. Again, I should point out, a lot of this doesn't have to do with you working. Whether or not you're working, whether or not you're retired, isn't 100% tied into all this stuff. And that's another part we need to talk about, right? So what happens if you are working? Well, once you're full retirement age, you make millions of dollars or whatever. Warren Buffett, he gets his full Social Security, no problem. But if you're starting, quote, early, which is again 62 and up, if you make over 18, this number changes every year. So this year is 18,960. So if you go over that, so say you made 19,960, you made $1,000 over that. What they're going to say is that's for those $2 that you made over that, they're going to take back $1. And so you're going to only get $500 of, you're going to get $500 taken away from your Social Security because you made $1,000 more. Well, if you're making, 70, 80,000, it's all gone. You're not going to get any Social Security, but you did lock in that penalty from starting early. So if you think you're going to work, do not turn on Social Security. There's no benefit for doing that. And now the really funky one is the year in which you turn your full retirement age. Again, this may not be your birthday. Say somebody was born in December of 55. Well, their full retirement age is actually February of next year. So that would not be the age this year when they turn 66. It would actually be, in 2022. But in the year you reach your full retirement age, you can make up to $50,000. If you go over that, for every $3, you lose $1 of Social Security. But once you hit your full retirement age, sorry, not birthday, your full retirement age, then what happens is you can make unlimited amounts of money. So it's only only up to that point. And so if you're, say your full retirement age, like the example I was giving you there in February, you can probably turn it on January because there's probably a pretty low odds you're gonna make $50,000 in the 1 month. But if your full retirement age is actually in, say, December, it's going to be very tough because you may have made more money. So, but again, once you're full retirement age, you can turn it on right then and there. And so that's one of the things that's really good to do. And by the way, I forgot to, I was looking at the chat. So, uh, so the let's see, yeah, 35 years is a long time. That's true, Alan. And the CPI, yeah, they're always messing around with CPI, Mark. That's correct too. So, and so yeah, I haven't gotten into the examples yet. So some people are asking about that, and I'll give you a second here. So, let's go through some actual real numbers and say, okay, what's going on there? And so this is Brad and Ashley. They're both going to start at their full retirement age. They're the same age, so they both start at the same time. So what happens there is his benefit was $2,000 a month, and her Social Security benefit's $600. Well, so what happens is once your spouse files, now this is very critical. It's only when your spouse files. Once that spouse files, then you are eligible for spousal benefits. You cannot get your spousal benefits if your spouse hasn't filed. You can only get your own benefits. And so in this case there, her benefit was $600, but half of his benefit is $1,000. So she would actually take the $1,000. Obviously, it's a way better deal, more money, right? So you want to get that extra money. Now, this changes depending on when he turns it on, depending on her age. So there is some other things that you want to look at before you do all this planning. So those are, it's very easy when you're both the same age. It makes it a lot simpler. But let's change that up a little bit. So let's say Brad now wants to start at age 62. Well, we know he's if he was full retirement age was last year, if he was born in 1954 or earlier, then he'd have a 25% penalty. Now it's a little bit higher. So his 2,000 now would be 1,500. So he's going to get a lot less for the rest of his life, but he gets the check now, right? So, so what does that mean to his wife? Well, her Social Security benefit would be $450 a month as her own benefit, but now, and this is kind of the confusing part. This is a little bit of a nuanced thing, so kind of try to catch this. It doesn't actually matter when the whatever you want to call it, the higher income spouse, turns on their benefit. The spousal benefit is still based off of the full retirement age. So in this case for Brad, remember his full retirement age benefit was $2,000. So even though he turned it on, he's only getting $1,500. Ashley's still going to get a percentage of his full retirement $2,000 number. So that's kind of a nice thing, right? That the one spouse taking it early doesn't harm the spousal benefit. But the problem is if you start it early, again before full retirement age, so in this case it's the worst early, the youngest age 62, then you only get 35% of the benefit. So yes, she's getting a percentage of the 2,000, but now it's only 35%. Had she waited to age 66, she would have gotten 50% of the 2,000. So now she's going to get $700 for the rest of her life. But again, it depends on the situation, right? Maybe Brad lost his job. He can't find a new job. It's really tough around here to get a new job when you're older in Silicon Valley. And so maybe they just needed the cash flow, right? So sometimes that may make sense, because if neither one's working, then yeah, you might want to take it. Maybe both of them have some pensions and they don't need the money, so they just want to get the money that they paid in back out. I have a lot of people that like to talk to me about that, saying, hey, I paid this money in, I just want to make sure I get that money back out. And so that's one of the issues. And somebody else mentioned taxes. We'll cover that a little bit here. So, and then let's flip it to the other side of the coin there, the other direction, right? Let's go late. So say they're both 70. And so Brad waits all the way to age 70. Now his benefit, remember, he gets that 8%, that 32% higher. So now he's going to get 2,700 at age 70. Now, if Ashley waited, she would get her own benefit of 600 at 66. So there's no real reason for her not to turn that on, because she knows once Brad turns on hers, she's going to get a pay raise. So it'd be really dumb for her not to turn it on actually at her age 66 number, or full retirement age, because then she can start getting that income coming in. Then once again, if Brad hasn't turned on his, the only benefit eligible to her is her own benefit. So then once he turns on his at age 70, he'll start getting that check, and Social Security will say, oh, hold it, Ashley, we're going to give you a pay raise. We're going to give you now 50%, not of the age 70. It only goes to the full retirement age. We're going to give you 50% of his full retirement age, going back to that $2,000 benefit. So sometimes people say, oh, well, if my spouse waits to 70, I'm going to get 50% of that age 70 number. No, no, you don't. I mean, I think one of the biggest problems that Social Security doesn't do is they don't send out a marital joint statement. I mean, why not? Because this is how they do when you actually apply. It would be a lot nicer and easier if they did that, but they unfortunately don't. And so, yeah, that's why you really want to be paying attention to that, because if you thought you were going to get 50% of 2,700 and all of a sudden you get 50% of 2,000, it's not quite the same amount, but still it worked out pretty good. And somebody's asking if you're a teacher, and if you're a teacher if you played outside of Social Security, we'll talk about that in a second too, because there's some specialty rules that really can mess you up there, and unfortunately take some of your money back. And so, all right, so let's do another scenario. So let's again go back to them both being age 66. And so now he turns on his benefit. And so, she can turn on hers at age 62. She could have turned on her own benefit, 450, and still then switch over to get now only 35% of the spousal benefit of the full retirement age. Now, why does she only get 35%? Because she's waiting to age 66 to her full retirement age to get that spousal benefit. Well, Social Security is like, well, hold it. You started money early. We're trying to get you not to take money early. We want you to retire. If you're going to be retired. But if you want a lot more money, you really should be working to full retirement age. And so since Ashley took her money early at 62, now not only does she get a lower benefit for herself, but her spousal benefit now has also been penalized. Even though she waits, she can't get her spousal benefit until age 66. So that's if Brad had started his earlier, she could have gotten that $700 sooner, but she can't get again that spousal benefit until he files first. And so that's one of those things also to be thinking about, that if one spouse starts early, they will have that permanent penalty. And by the way, if you start at 63, 64, there's still a penalty, it's just slightly smaller. So it gets lesser and lesser as you get closer to that full retirement age. So even waiting a year, the penalties will be less, the money will be a little bit more. So depending if you want to work maybe one more year or 2 more years, it may make sense, right? And another thing, by the way, you don't have to have Social Security turned on to retire. As long as you have enough other assets, you can still do it. So, that's the other weirdness about probably the last, I'd say, 10 years. I mean, I've been doing this for 30 years now. But in the last 10 years, you've seen a lot more people retire and then turn on Social Security later. So that could be another, thought process. So, what are some changes that happened? So there's a thing called file and suspend. And if you heard of file and suspend, the best thing you can do is try to unlearn what you learned. And unfortunately, in 2015, they got rid of that. Now, what this was if, say, going back to that last scenario or something, say Ashley turned on her benefit, Brad could turn on his spouse benefit and then wait to age 70 to turn on his own benefit with no with no ding, no deemed receiving it. And so it was a great deal because especially if spouses were close in age, and especially if they're both high income earners, if they're both pretty close in Social Security benefits, they maybe one had 3,000, one was 2,500. Well, the one getting the 2,500 could turn theirs on. The other one would get half of that, and then at age 70 they would get even a bigger number because they waited the longer to age 70. Uh, that was not how that law was supposed to be, And so what happened was they got rid of that option. There's a couple people still left. If you're born before 54, click the button to to meet with us or something, because we can kind of go over there. There's not that many people left because just in terms of the age, most people have already filed their benefits and such, and it depends on what your age of your spouse is and such. So, but file and suspend's gone. So now the law basically is, this is the easiest way to think of it. You have to take the higher of whatever's available. Why I say available, again, in that last scenario, Ashley turned on her benefit at 62. She could not turn on her spousal benefit, even though it's a higher benefit, because Brad had not filed. Once he files, she'll switch to his. She can't wait and get a higher benefit on her own or something like that. So it's going to be always whatever is the better one. Now, if you flip it the other way, maybe they had pretty close to earnings. If she turns it on and her benefit's always higher than the spousal, she turns hers on at 62, it'll never change. It'll be always at that lower number because she turned it on then, and so she'll never have the spousal option. And that's what the file and suspend had, this fancy term called a restricted application for spousal benefits. So again, not too many people are really in that anymore, because they had this phase in and stuff from 2015, and pretty much almost everybody now is over that age to where you can't get it anymore. And yeah, somebody asked if there's anything to do with gender. No, there's nothing to do with gender in any of these things. So it doesn't matter who's the higher income earner. Doesn't matter. It's really just, I always look at whoever's the higher income earner. That's the one you typically want to have start the benefits the latest. So that's kind of the way to think about it. And real estate income has nothing to do really with Social Security, but we'll get into taxes a little bit in there. So what are some other things to be thinking about? Well, the only spot where kind of the file and suspend kind of still exists is survivor benefit. Sorry, that's widow benefits. So sorry, I have this out of order. Survivor benefits, we'll talk about that first. So what happens when one of you die, right? Now, if you're single, it's pretty easy. Your check stops and that's over, right? But if you're married, the higher of the two checks stay. So going back to Brad and Ashley, if he was getting 2,000, she was getting 1,000. If he dies, her $1,000 check gets bumped up to 2. His check, or her smaller check, now is kind of gone. So just think about whatever is the higher number. It's also with the cost of living, so they don't make you go back to old numbers or something. So whatever that current check is, the bigger check stays, the small check goes away. Now, if you're both high income earners and maybe your check's 3,000 and his check's 2,800, well, only the 3,000 stays, but the other 2,800 goes away, and that's where that surviving spouse is gonna be, changing their assets, right? They're gonna be withdrawing a lot more from IRAs or other investments, and again, that's something to be paying attention to. But that's why I say the eternal check, that bigger check, you want to have to be the biggest. So whoever had the higher income earners, doesn't matter male, female, just whoever had those higher 35 years of earnings, that's the person who should start last. And then the person who had lower amount, well, that one you could start sooner because that check won't be there for as long. And then divorce benefits. So one other odd thing about if you were married to somebody for 10 years and then you got divorced, all the same stuff that married stuff pretty much applies, with one big massive change. Your ex-spouse does not have to file for you to get spousal benefits. So if Brad and Ashley had divorced and Ashley wanted to turn on her higher spousal benefits, she could turn it on right away. And so she doesn't have to, it doesn't matter what ex-husband Brad was doing now. If he still hasn't turned on his, doesn't matter. She still gets it. Hardest part, you don't know the number. So the only way to do that is you have to set up in a time with Social Security, and you have to bring your marriage license, your divorce decree, and both Social Security numbers, and then they would tell you what the benefits are. So again, that one's a little bit more complicated, but definitely something to be thinking about. And now widow benefits. Now widow benefits is the only place where file and suspend is still kind of around. And so with widow benefits, at age 60, so getting rid of all those other numbers, Social Security threw in a different number. So at age 60, you can actually get roughly, it's about 71% of what the person who died would have been getting. Now, why do I say would have been getting? Because everything else was full retirement age. Well, say your spouse, say go back to that example of Brad. Maybe Brad was 69. He still had not turned on his Social Security benefits, and he dies right then. Ashley would actually get 71.5% of that age 69 number benefit, not his full retirement age. He would actually get a higher paycheck. Which is kind of fair, right? Because he hadn't turned them on yet and such. So if he had turned it on and passed away the next month, she would have gotten that full check, right? So it does make more sense that they get a percentage of that. So that's the only weirdness about widow benefits is two things. One is they can start at age 60, a lot younger. It won't be quite as high if you start early because there is also a penalty for that again. There's also work earning restrictions. You have that same thing about full retirement age. So if you make too much money, widow benefits may not be a good deal. So those are some things that you have to be paying attention to. But whatever you're getting from widow's benefits, if your benefit is higher, you can switch to that later on. They do still allow you to do that. Now, somebody asked about getting divorced and refiling. So this is the crazy part. So if you get divorced, you were married for 10 years, get divorced, and get remarried, and it was before age 60 and you were married for another 10 years. Once you're remarried, the first marriage is pointless. There's no numbers there. It's only the current marriage that you get the numbers from. But if you're over 60 and you're married for more than 10 years and then you marry somebody else and then you're married and you get divorced from that person, you can pick which of the higher two ex-spouses had a better earnings. Really weird, really goofy. I don't know how many times that comes up. Probably not something to shoot for, but it is something that they've thought of. And so, yeah, there is some weirdness about divorce, and especially over age 60. So, again, that would be one where you probably want to talk to us and we can get a little bit more detailed information for you. But, if you got one of those weird situations, it's always good to get really good detailed info for your specific situation. And then, so let's go through another, talking about the spousal benefits. So again, so if Brad died at 70, his benefit would have been $3,000. Ashley would get a benefit of 71.5% of that $3,000, so that $2,145 at age 60. Now, if she's working, she may lose a lot of that, but she could get that right then. Another one, if he died at 62, she would only get, and he turned on his benefits after he had selected it. She would only get 71.5% of the $1,500. Now remember, before the normal spousal benefit was at 66, would have been $1,000. But this, of course, is age 60, so she's getting it a lot sooner. So she's getting $1,072 now. So it is a little strange on how the survivorship stuff happens for widows. Again, that's one where you really want to make sure, and then if you have, so this one we're not talking, somebody was asking about disability stuff. Disability is very different. So disability is a whole nother thing to be talking about. One thing that if somebody passes away and you have kids under 16, you actually get money for them also. That's on one of those statements from Social Security. They'll tell you how much you'd get for the kids. Once they hit 18, that money's over. But so there's, and that money's all tax free. Typically, most disability benefits are going to be tax-free, but disability is a whole nother, a whole nother can of worms. It's a little bit more complicated. Um, and so then, what are some other things that somebody asked about this for teachers? Uh, so there's in about 15 states. There's in California is one of them. Teachers don't pay into Social Security; they pay into their own thing. So in California, they pay into STIRS, S-T-I-R-S, State Teachers and Retirement System. And so what happens there is they say, well, hold it, you weren't playing ball in our field. You were on a different field playing and put money away there. So we don't think you should get as much money. So how do you qualify, first of all, for Social Security? Well, you have to have at least 10 quarters. 40 quarters, which is 10 years. So if somebody worked in, again, maybe they're doing, worked at the movie theater, worked in fast food during college or something, they may have gotten their 40 quarters, their 10 years of earnings, and then became a teacher and spent the rest of that time in teaching. So they're going to have a very good pension probably from STIRS. But what's going to happen is whatever their Social Security benefit is, and this changes year by year. This year it's $498. So if the benefit, say, was $1,000, they're going to get 502. But they don't put that on your statement. So that's the annoying part, because you see the full amount you're going to get, and no, you're not going to get that money. So that's one of the issues that you got to watch out for if you're a teacher. If you're City of San Jose, they don't pay in Social Security. There's some people from the county, couple other government jobs. If you paid Social Security tax, this does not apply to you. If you have like a corporate pension, if you're an old Lockheed or Northrop or any of those type, all those people had to pay into Social Security. It's only if you had no FICA tax ever on your pay stub, that's who gets hit by this windfall elimination provision. And so the worst thing you can kind of do, and sadly, is if you work, say, like 20 years in private sector and 20 years teaching, because you're not going to get a huge teacher pension, and then they're going to also take money away from your Social Security, even though you didn't get as big a teacher benefit. And they're not asking how much you got. They're just saying if you got it, you're going to lose some of this money. Now, the other thing is, if you're a teacher and you're not getting Social Security, or you're getting very little Social Security because of the windfall elimination provision, but you're thinking, well, hey, my wife was in private sector. She's got a good, like maybe $3,000 check for coming in from Social Security, so I should get her check when she passes away, right? The higher the two checks. Well, then there's this other thing called the government pension offset, or GPO. And so that would be where they take away 2/3. They do this calculation, and if your pension is more than 2/3, then they take away that amount. So you might get some, depends on what the numbers are. Again, if you have that situation, we want to really plan for that, because you're not going to get nearly as much money as you thought. And that's a big deal, because if you're planning that, that can really mess up your planning. So somebody else asked about taxes, right? The big T. So back in 1993, they said, hey, we need a little bit more money for Social Security, so we're going to be, doing some of these changes to retirement age, and then we're just going to tax only the people who are really wealthy. The people making over $44,000, or the single people over 34. Well, let's see. In '93, you could buy a house around here for, what? Well, we bought ours in '94 for $250. So 200,000, right? So that probably wasn't that extreme a high income, but it was a little bit okay income then. They did not change those. They never indexed them with inflation. So these are the same numbers from the '90s, and they are not going to change. So pretty much you can count on your Social Security being taxed. So what do? They say, okay, for the first, so if it's, again, you can see on the chart there, if you're single, under 25K, or married under 32K, there's no tax due. Well, how do they figure this number out? It's this thing called MAGI, M-A-G-I, which is Modified Adjusted Gross Income. And what they do is they look at municipal bond tax-free income actually gets taxed in this calculation. So if you have tax-free income, not going to be helping you in this. So they're going to add up all your income that you get, and then they're going to look at also half of your Social Security. So say you're getting, $24,000 a year in Social Security. Well, 12,000 is already there on this calculation. So if you got 13,000 single, or if you got, up to 32 on the married side, then you're now going to have that money over that B tax. So the next little phase in, if half your money gets taxed, and then once you're over 34 or 44,000, it's 85% of your benefits taxable. So easy way to think about it is just assume 85% of the money you're getting is going to be taxable. So if you're getting $1,000 a month, 850 is going to be taxable, 150 is going to be tax free. Weird part, California, no tax. There's 41 states that do not tax Social Security. We're amazingly one of them. So if you're thinking about where you're going to want to retire, make sure it's a state that doesn't tax Social Security. But so that is the one nice benefit, is at least on the state side, your taxes won't be as bad. But on the federal side, they're going to still be there. And by the way, somebody was asking about when I'm talking about work income, when we were going back to earlier, that work restriction, that's only for earned income. So that's only if you're working. So that means if you're getting a W-2, a 1099 as a consultant, or maybe you have your own business. If you're getting dividends, IRAs, any of that other stuff, real money from real estate as a rental, none of that counts into that working penalty for getting Social Security. Everything pretty much counts on this calculation. So even stuff that's not taxable, like municipal bond income, counts in this calculation. So it's polar opposite on here. So this one's all work income, all unearned income, IRA income, anything. So if you think about that IRA income, well, hold it. I take money out of my IRA to get more cash flow, and I may jack up my taxes on my Social Security. But hold it, nobody told me that. And guess when you figure this out? At tax time, when it's too late, right? So again, this is why you have to have a plan. This is why you have this be part of an income plan, because if you structure stuff right, now the only thing that doesn't show up in here is obviously if you're borrowing money or taking money as a loan from life insurance, or you're taking money out of a Roth IRA, those are truly tax-free items, and so those do not show up. So the cool thing here is you could actually maybe 1 year live off your Roth money, and then the second year so in the second, sorry, somebody said it was going, I went offline, but it still says live. But so that second, so 1 year you could get that tax-free income. The other year you could, change it and not be taxed. So, there are some options there that you can do. So this you can't really read, but this is just basically talking about that same situation. So say you had you just had 25,000 basically of Social Security income. Part of it's going to be taxable. If you didn't have really any other money from any place else, and you have your standard deduction, you pay almost no tax. But if all of a sudden you took out some money from your retirement accounts or had other interests or earnings, you may pay a ton of tax and have almost all your Social Security be taxable. So again, this is one of those things where you want to look at that and make sure that you're planning that out well, because of that could be a big difference. So sometimes you could plan it where you have no tax year. And so somebody asked also about if you're outside the country. Outside the country is really complicated, but every single, because I have a lot of clients that are looking, retiring in another place. I have one in New Zealand, I got one in Germany. And so what happens is every country on earth has a tax treaty with the US. And so it depends on the tax treaties, but basically think about it as anything that you're taking, you're going to still have to file a US tax return. If you're taking money out of your IRA, it's still taxable in the US. If you're taking money out of your Social Security, it'd be still taxable in the US. But a lot of the other stuff would not be. So you might be under those limits then. And especially depending on what your required minimum distribution is at age 72 and such. If it's not that high, if you got more in Roth, you could probably get maybe all your Social Security be tax-free, if you plan that out well. Again, you got to have that plan ahead of time and make sure, because if you have a lot of U.S. taxable income, you're going to still pay that tax on the Social Security, even though you're not here. And so that can be complicated for sure, but but there is ways So the weirdest part about, I guess the best way to say it is, the weirdest part about retiring is you get to pick where your income comes from. You can pick when you turn on Social Security, right? So you can pick what age that is. And so if you retire before that, you've got a lot of opportunity, maybe move more money to Roth, make stuff more tax free, maybe have a little bit better tax situation. Once you have that Social Security, well, now you got a baseline of income. And then once you hit 72, that's the age now. It used to be 70 half, now it's 72. That's where you have to. Doesn't matter if you need it. You got to take money out of your retirement plans, your 401ks, IRAs, and all that. So, you're going to be first retired, maybe not have Social Security on, so you have only so much income, have Social Security, and then 72, you have all that Social Security income and those required minimum distributions. You don't have much choice in the matter after that. Right then, it's going to be the tax, whatever you're going to pay the tax. So you have very little planning then. So that's why you want to do that planning ahead of time to figure out, okay, how can I pay the least tax over my lifetime? Not my least tax in 1 year, but over my lifetime. And lots of times people ask the wrong question. They ask, how do I save money on tax this year? Bad question. How do I save taxes for the rest of my life? That's the right question. So a lot of times you hear this thing about this break even thing, and they'll say it's 78 or they'll say it's 80. What is the break even calculation talking about? Well, that's saying if, like, was it Brad was going to get 2,000 at full retirement age, or 2,700 at age 70. So when does that total of that 2,700 equal that total of the 2,000 a year, from 66 to whatever age, and equal and cross over for that same 2,700? What's that missing? So the biggest problem I have with that calculation and that really kind of simplified math is, if you retired, say at 65, or let's keep it easy, you retired at 66 at your full retirement age. So if Brad retired at 66, what did he not get for 48 months? He did not get $2,000 a month. So what did he do to live to get that $2,000 a month? He didn't just not have expenses, right? He had to live. So, he had to take out $96,000 out of his retirement assets. These are the worst years to take money out, right? The earliest years mean the compounding is less for a lot longer. And so what happens is, if you take that out, it's not just when does that equalize that 70 versus 66, but it's also that 100,000. When can you recover that? Because you have to get a lot more money to overtake that 100,000 that you did not get for those 4 years. And so I've actually done income plans before with clients that, especially for single people, I find are probably the worst at this. Is if you wait longer, a lot of times it burns up too much assets. And it was actually worse to get more money at 70 than to get less money at 66, which you kind of go, what? Getting more money is always better, right? But no, the burn rate was too great, and the accounts couldn't recover enough because they had to take out so much money out of those accounts early on to make it for those 4 years. So again, the only way to really truly see how this all plays out is part of an income plan, and saying, okay, if you're taking this money out now with the earnings and so forth, and then even if you throw in some cost of living adjustments and so forth in there, when does that really cross over? And what I find for a lot of people, that age is really closer to 83, 85. Let's have a little bit of reality check. When do you want to have more money? When you're in your 60s or 70s, or when you're in 80s or 90s? I mean, for me, I want to be able to do it when I can do fun stuff. I mean, I did my 50 miles in all 50 states in 25 months on my bike. I do want to ride from Maine to Florida, and I've got some other goals to ride across Canada. There's some other ones in there. So, I've got to have some time to do all these crazy things I want to do. So I'm not going to wait till I'm 80. So I'd also rather have that money earlier. And so, so that's one of the big things that you have to be thinking about, is when are you going to need that money, and how's that going to be spent, and what's the reality of that? Because usually most people spend more of their money in those first 5 to 10 years of retirement, when you want that bigger cash flow. So that may make you want to start a little bit sooner, at more closer to full retirement age than age 70. Also, if your spouse is pretty close in age, then if you turned on yours, they may get a bump up for the spousal benefits, and then that makes it even more valuable because that's one other big thing that doesn't calculate. I've got a client right now. We were just meeting yesterday actually, and she wants to retire in January, and if she retires there, her husband already is on his benefit, but once she retires, he's going to get a $700 a month raise. Well, that's $700 extra a month for she's only going to be 68. Um, that's two more years of getting $700 a month. That's not part of her benefit. It's because of her benefit, but it's not on that statement. And if you did a break-even calculation and you didn't include the 700 he's getting, you'd be way off. So their break-even would be way, way later than that. So again, got to do it in context of everything. So what are some things you have to think about? Well, if you're monstrously overweight and seriously bad health and all that stuff, you might really want to turn it on at 62, right? Because if your life expectancy is not as high, you might want to get it sooner. I've got a lot of clients that have they're in their mid 60s and their parents are still around in their 80s or 90s. Well, then that's when you might want to definitely at least wait till full retirement age or go a little bit longer. So again, it depends on your not only your health, but also your spouse's health. So if you're married, guys are really bad about this. Hey, I'll just turn my benefit on. Her check's small. We'll wait for later. No, your check will, most statistically speaking, guys, go away first. So, if your check's bigger, you want that check to be bigger for her for the rest of her lifetime. So, so you do need to kind of do that math. So you have to not only think about your needs, but the beneficiary needs of who's going to get that. If you're single, then it's just, what's your life expectancy, what's your health status, and go for it from there. Obviously, what kind of bills and expenses you have, what timing of those cash flows, and how does it incorporate with your other assets? What are some other things that you can do? I mean, sometimes we have people, like I had a client last year, she had a pretty big capital gain, and she was turning 66. She wanted to turn on her Social Security benefits. Her full retirement age was August, and I said, well, why don't we wait till January? We'll turn them on in August because you can go backwards 6 months. So she actually, in essence, turned it on in August, but she didn't get the check until January. And what did that do? Well, that put that taxable income in a much lower tax year. And so those are little tricks that you can do to in terms of timing and working with your other assets to make sure you're getting that lower tax, right? And then obviously, how does it look with the rest of your portfolio? Because one thing that if you're running both people living forever, and that's fine, but if you both have big retirement, Social Security checks, and all of a sudden one goes away because one person passed away, you're going to be withdrawing assets a lot faster. So you want to make sure that stands that test of time. You want to make sure you got that cash flow coming in, regardless if it's a good market or bad market. If we have another crash like last year, and that was a quick recovery, but if we have another 08 or 09 where it takes a lot longer to recover, that's where that Social Security money could be really helping out, and you're not having to spend and cash in those other assets. So it really needs to kind of all work coordinated together. So those are some other things to be thinking about. And then really, if you wanted to spend some time with us to figure that out, we can create that income plan for you. We can do it on Zoom, we can do it in person, whichever way you want. But basically, we can kind of look at, okay, what are you spending for the rest of your life? Where are your assets at? If we do Social Security now, how much money is left down the road? Or if we do it later, how much money is left down the road? Whichever one's higher, that's the one we want to do. I don't know which one that will be until we do the plan, right? So it's the easiest way to figure it out is to run your own numbers with your own situation, right? And if you have that, spousal benefit situation, or maybe one's going to get a bump up, we want to throw that into that calculation too, because that's a harder calculation to have. Our software puts it all in there, knows the taxes, and even if you change states, we can flip it to whatever state you're going to be in and see how that does. So, and then you also want to look at that risk level that you have right now. Everything's up crazy up, and that's only because the government's printing money left and right. So that'd be the other thing to be looking at is, going forward, are you locking in some of those dollars? Are you going to have some other guaranteed money coming in? Because if this Social Security is the only guaranteed source of money, and the government does do some higher tax on it, or does something that's a little more draconian and really brutal come 2034, 2035, what then, right? So I don't think they're going to go after the people who are retired right away, but there could be something like, hey, we're going to tax 100% of it versus 85. That could be a pretty easy one that they could do to people on that right now. Or maybe they say if you have so much income, above a certain number, we're going to tax it fully, at 100%, and you'll lose that 15% that's not taxed. So there are some stuff that you want to make sure you've got some income that's guaranteed, that's going to be coming in, that's irrespective of government control and Congress control, right? And then also how to reduce those taxes ongoing, right? So, do you take it now? I mean, sometimes we've had people where we take Social Security a little bit later, so we do more Roth conversion, so they pay less tax at 72. So it's kind of like a lot of moving pieces in there, but sometimes it may make a lot of sense. So, so that's one of the things that that you really need to be looking at all of that cohesively. If you want to set some time with us, definitely you can. My process is called the Blueprint to Worry Less Wealth. We create that income plan, that investment optimizer, make sure you don't have too much risk, make sure everything's in where it should be, minimize those taxes, look at how this all affects your healthcare too, and long-term care issues like that, and then legacy. How do you get the most money left to people you care about versus the government and other people? During the COVID times, we actually stopped charging a fee for that. So we actually have the first meeting. So again, on the side of the screen, there should be, you can click there to set a time. And so, so if you wanted to set a time to talk, yeah, we can do that. We can go over all these things. If you wanted to go into the more overall planning, we can do that. There's no cost for us showing you where you're headed. And then we just tell you, here's some issues that you got to fix. And then beyond that, it's up to you if you want to work with us or not. So let's see here. I am trying to see if there's any other questions. So yeah, definitely if you got some more questions, because I want to respect everybody's time and finish this up on time. So, if you do have another question, put it in the chat there. We'll also leave the chat open for a little bit, because sometimes people have, after they kind of heard all this stuff, and then they finally go, oh yeah, what about this? And so again, you can put that in there. We'll leave the chat open for a few more minutes and such. But if not, just shoot us an email at wealthcreator.com. You can go on there, or you can text us. You can text us at our main phone number too, and stuff like that. So again, it's very complicated. It's a little bit more than you think on Social Security, especially if you're married. If you're single, then it's more just, okay, how does this coordinate with my other assets? When should I do it? When does it make sense? And again, don't spend down your assets trying to get a big Social Security check. That might be the wrong way to go. So again, that's where you need to look at an income plan. But I appreciate everybody logging on tonight. And if you got any more questions, let us know. Put that in the chat. And otherwise, again, have a good night, and we'll talk to you soon.